We'll move on from that for the moment and go to Blackmore Capital's Marcus Bogdan. He's on standby in Melbourne. And Marcus, it's a pleasure to have you on the program today. Your take first up, because I always like to, in the first hour of trade, get your view on markets and how we're tracking at the moment at 61.93. How are you viewing the bourse, the ASX 200, given the fact, yes, we're seeing a bit of a pullback today, but it's been remarkably strong over the last few weeks?
Sure. Good morning, Ingrid. We're leaning far more into a cautious view now after a sort of a 14% rebound since the lows in December. In early December, you're able to buy the market around 14 times, which was around the long-term average of the market. So it was a sensible time to reallocate back into stocks. Now you've had a substantial rebound. Obviously, that's been driven by what's happening in the US and the Federal Reserve being more patient around interest rates, and also the fill-up of these large dividends, which we've all talked about in the last reporting season. But earnings per share growth and earnings growth in the last reporting season is still very modest, and the trajectory, if you look at last year to this year, is certainly slowing earnings growth. Given the market's around 16 times now, I think it is a time to be more balanced and more nuanced and bringing some capital back into cash.
All right, well, let's talk about some of the key stocks we're watching from reporting season. I just want to touch on Ramsay Healthcare, because I know that's been one of the highlights of February reporting season for you. What's your take on Ramsay at the moment? Because I know our guest host, Mike McCarthy, has something to say about this as well.
Yes, sure. Ramsay have really rebased their earnings base. 3 years ago, they were growing their earnings by 14 to 16%. Now they're forecasting growth around 2%. And that's a reflection of difficult markets in the UK and France and slowing growth in Australia. But that's been reflected in the valuation. It's come back from around 30 times to around 20 times. And I think the result was incredibly important because it showed that there was a line in the sand that 2% earnings per share growth was the lowest that earnings would go down. And now I think going forward, I believe that earnings growth around 5 to 7% is achievable, and that is fair value given where the valuation is today.
Marcus, there's a Royal Commission inquiry into the sector at the moment. Clearly, Ramsay has a slightly different profile to many of its listed peers, and it has its international operations. There's an argument that I'm hearing at the moment that it is also a higher quality operator in the space and could therefore outperform its peers. Do you put any weight on that view?
Oh, the quality of the earnings, the quality of the assets. They own the hospitals, they own the land in Australia, and they have executed incredibly well over the 10 to 15 years that I've been following the company. And then reducing that regulatory risk, which is everywhere in the market, with operations in the UK, France, and now Scandinavia. And so I still think that the underlying thematics around ageing populations are driving growth in hospitals, albeit we are starting to see pressure on private health insurance premiums, but then I think execution, scale and productivity is incredibly important there. And that's why we've reintroduced Ramsay back into the portfolio following the rebasing of their earnings. What's
your take, Mike?
Oh, it's one I'm watching right now. Yeah. Appreciate Marcus bringing it up for us because, look, I agree. I think it has suffered because of that big change in its profile, but it's come back so far in price now that it's one that I'm seriously looking at adding to the portfolio for the long term because of that thematic, that exposure to an ageing population.
Another one is Cleanaway Waste, and this is just interesting in light of one of its somewhat competitors, Bingo, I guess, which we've been watching for different reasons over the last few weeks. What's your take on Cleanaway?
Cleanaway was an outstanding result. The result led to significant upgrades in broker estimates. They delivered 9% underlying sales growth and nearly 15% in EBITDA growth. It's in an essential industry. It's got a very different makeup to Bingo. It's far less cyclical. It's far more integrated across the waste management spectrum. It has a very strong balance sheet, and I think it can deliver 10% plus earnings per share growth over the forecast period, and it remains a core stock in our portfolio.
We've seen a fair bit of M&A activity in the space, and the latest, of course, is Bingo's bid for Dial a Dump that's recently been given ACCC approval. Do you see potential for further M&A activity in the waste management space?
I think, look, Cleanaway purchased Tox Free last year, which was a particularly large acquisition for the group, and it gives them a new vertical to move into, which was healthcare waste, and that is again in an essential industry in health and health waste. There are always opportunities for M&A, but I think for Cleanaway now, the importance of bedding that acquisition down, getting the synergies of $35 million over the next several years is paramount for them.
And given the increasing scale that's coming into the sector with this consolidation, do you think groups like Wesfarmers might be examining groups like Cleanaway?
Well, I think Wesfarmers, and as your guest earlier pointed out, I mean, they have one of the strongest balance sheets on the ASX 200. They've got debt of $324 million on a market capitalisation of $40 billion, or net debt to EBITDA of 0.11 times. So Wesfarmers has certainly got the capacity to make a sizable acquisition. I think they are incredibly careful now, given the problems that they had in Bunnings UK. But looking back more locally and to more industrial businesses would make sense at the right price. But I don't actually mind them having such a strong balance sheet late in the investment cycle, because it does give them the ability to invest counter-cyclically into the market.
What do you think, Mike? Because looking at Wesfarmers in particular, some speculation yesterday from the Australian that perhaps they could be taking a tilt or want to take a tilt at New Farm, given the valuation of New Farm, I guess, at the moment. Obviously not as many synergies as something like an Instant Pivot, but certainly the value seems to be there, or the valuation. It's a key.
Whenever I sit down with traders at the moment, share market traders, it's the key question. What's Wesfarmers going to buy? And they're all trying to position for it. But I think Marcus makes a good point. They've shown real discipline over the years and over the cycle in the past, and given their experiences in the UK, they will be, I think, even more cautious than they have been in the past. At the same time, they're basically ungeared, and that's an extraordinary situation for an investment group like Wesfarmers.
Yeah, but you don't want a lazy balance sheet, do you? I mean, you want them to put that money to work ASAP.
Absolutely.
I think investors are just waiting. It's such a key part of it, isn't it, Marcus, just looking at Wesfarmers and what they might do next, because it's almost unknown as to it is unknown as to the next sort of strategy in its business, and this could sort of realign Wesfarmers as a different business.
Certainly. I mean, at the moment, they've still got very much a retail bias. I mean, you've got Bunnings there at 57% of earnings. You've got Kmart, Officeworks and Target, and a much smaller industrial business. So bringing some breadth and some further balance into that portfolio, I think, is essential going forward.
All right. Well, Marcus, we really appreciate your analysis. We've got to leave it there because we're out of time, but thank you very much for joining us on the program.
A pleasure. Thank you, Ingrid.